So that was a mistake. On long-term capital, we have learned other businesses that are associated with securities over the years. And, I mean, one of them is arbitrage. I've done arbitrage for 45 years, and Graham did it for probably 30 years before that. And that's a business, unfortunately, I have to be near a phone for, and I have to really run out of the office myself, because it requires being more sort of market attuned, and I don't want to do that anymore. So unless a really big arbitrage situation came along that I understood, I won't be doing much of that. But I've probably been in 300 arbitrage situations at least in my life, maybe more. And it was a good business, perfectly good business. Long-term capital has a bunch of positions. They got tons of positions, but the top 10 are probably 90% of the money that's at risk. And I know something about those 10 positions. I don't know everything about them by a long shot, but I know enough where I would feel okay at a big discount going in, and we would have the staying power to hold it out. We might lose money on something like that, but the odds are with us. That's a game that I understand. There's a few other positions we have that aren't that big because they can't get that big, but they could involve yield curve relationships or on the run, off the run governments or things like that are just things you learn over time if you're around securities markets. They're not the base of our business. Probably on average, they've accounted for a half a percentage point of our return a year, or 3/4 of a percentage point a year of our return. They're little pluses that you get for actually having just been around a long time and learning a little bit about it. First arbitrage, not the first arbitrage I did, but one of the first arbitrages I did, involved a company where they were offering cocoa beans in exchange for their stock. That was in 1955. And I bought the stock, turned in the stock, got warehouse certificates for cocoa beans, and they happened to be a different type. They were trading in the New York Cocoa Exchange, but there was a basis differential in my favor, and I sold them. I mean, that's just something that I was around at the time, so I learned about. Hasn't been a cocoa bean deal since. 40-odd years. I've been waiting for another cocoa bean deal. I haven't seen it, but it's there in my memory if it ever comes along. And that long-term capital is that on a big scale. Yep. The question is about diversification, and I've got a dual answer to that. If you are not a professional investor, if your goal is not to manage money in such a way as to get a significantly better return than the world, then I believe in extreme diversification. I mean, so I believe 98 or 99%, maybe more than 99% of people who invest should extensively diversify and not trade. So that leads them to an index fund type of decision with very low costs. Because all they're going to do is own a part of America. And they made a decision that owning a part of America is worthwhile. I don't quarrel with that at all. That is the way they should approach it, unless they want to bring an intensity to the game to make a decision and start evaluating businesses. But once you're in the business of evaluating businesses, and you decide that you're going to bring the effort and intensity and time involved to get that job done, then I think that diversification is a terrible mistake to any degree. And I got asked that question when I was at SunTrust the other day. And if you really know businesses, you probably shouldn't own more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need, and you're going to make a lot of money. And I will guarantee you that going into a 7th one is going to, rather than putting more money in your first one, it's got to be a terrible mistake. Very few people have gotten rich on their 7th best idea. But a lot of people have gotten rich on their best idea. So I would say that for anybody working with normal capital who really knows the businesses they've gone into, a 6 is plenty. And I probably have half of it in what I liked best. I don't diversify personally. I mean, all the people I know that have done well, with the exception of, we mentioned Walter Schloss here earlier. Walter diversifies a lot. He owns a little of everything. I call him Noah. He's got 2 of everything. Yeah. Well, Procter & Gamble was a very, very good business. Strong distribution capabilities, lots of brand names and everything. But if you ask me, if I'm going to go away for 20 years, to put all my family's net worth in one business, would I rather have Procter & Gamble or Coke? Actually, Procter & Gamble is a little more, it'd be more diversified among product line, but I would feel sure of Coke than Procter & Gamble. I wouldn't be unhappy if somebody told me I had to own Procter & Gamble during that 20-year period. I mean, that would be in my top 5% because they are not going to get killed. But I would feel better about the unit growth and the pricing power of a Coke over 20 or 30 years than I would about a Procter & Gamble. Right now, the pricing power might be tough, but you think of billion servings a day, an extra penny, $10 million a day. We own 8% of it. That's $800,000 a day for Berkshire Hathaway. Get another penny out of the stuff. Doesn't seem impossible, does it? I mean, it's worth another penny. It doesn't. Right now, it'd be a mistake to try and get it in most markets. But over time, Coke will make more per serving than it does now. 20 years from now, I'll guarantee it'll make more per serving. They'll be selling a whole lot more servings. I don't know how many. I don't know how much more, but I know that. P&G's main products, I don't think they have the kind of dominance, and they don't have the kind of unit growth. But they're good businesses. I would not be unhappy if you told me that I had to put my family's net worth in P&G and that was the only stock I could own. I would, I might prefer some other names, but there aren't 100 other names I would prefer. Yep.
On that same model about McDonald's, can you go away 20 years from that?
McDonald's. The question's about McDonald's and going away for 20 years. McDonald's has got a lot of things going for it, and particularly abroad again. I mean, their position abroad in many countries is stronger relatively than here. It's a tougher business over time. People do not want to eat, exception to the kids when they're giving away Beanie Babies or something, people do not want to eat at McDonald's every day. I mean, if people are drinking Coke today, they drink 5 of them today, they'll probably drink 5 tomorrow. The fast food business is tougher than that. But if you had to pick one hand to have in the fast food business, which is going to be a huge business worldwide, you'd pick McDonald's. I mean, it has the strongest position. It doesn't win taste tests, with adults. It does very well with children, and it does fine with adults. But it is not like it's a clear winner. And it's gotten into the game in recent years of being more price promotional, and you remember the experiment a year ago or so, and so it's gotten more dependent on that rather than just selling the product by itself. I like the product by itself sells. I feel better about Gillette if people buy the Mach 3 because they like the Mach 3 than if they get a Beanie Baby with it. So I just think it's fundamentally a stronger product if that's the case, and it probably is. We own a lot of Gillette, and you can sleep pretty well at night if you think of a couple billion men with their hair growing on their faces. You go to, it's growing all night while you sleep, and women have 2 legs. It's even better. So it beats counting sheep. And those are the kind of business. But if you think, what promotion am I going to put out there against Burger King next month? And what if they sign up Disney and I don't get Disney? And I mean, that is, I like the products that stand alone, absent promotional or price appeals. Although you can build a very good business based on that, and McDonald's is a terrific business. It's not as good a business as Coke, but there really are hardly any. It's a very good business, and if you bet on one company in that field, aside from Dairy Queen, of course, you might bet on McDonald's. We bought Dairy Queen here a while back. That's why I'm plugging it shamelessly here. Yeah, way back there. What do I think of what? The electric utility industry. Well, I've thought about that a lot because you can put big money in it, and I've even thought of buying entire businesses. There's a fellow in Omaha actually that's done a little of that through Cal Energy, but I don't quite understand the game in terms of how it's going to develop with deregulation. I mean, I can see how it destroys a lot of value for the high-cost producer, once they're not protected by a monopoly territory. And I don't for sure see who benefits and how much. I mean, obviously the guy with very low-cost power, some guy's got hydropower, at 2 cents a kilowatt or something like that, has got a huge advantage. But how much of that he's going to get to keep and everything, or how extensively he can send that outside his natural territory, I haven't been able to figure that out so that I really think I know what the industry is going to look like in 10 years. But it is something I think about, and if I ever develop any insights, that call for action, I'll develop. I will act on them. But because I think I can understand the attractiveness of the product, and it's all of that, all of the aspects of certainty, of user need, and the fact that it's a bargain and all of that. I understand. I just don't understand who's going to make the money in it 10 years from now, and that keeps me away. Yeah.
Who do you think that the market is favored, the large cap blue chip stocks over small cap stocks over the next couple of years?
The question is large caps versus small caps, and why large caps overperform. I don't know the answer to that. We don't think we don't care whether companies large cap, giant cap, middle cap, small cap, micro cap. It doesn't make any difference. I mean, the only question to us is, can we understand the business? Do we like the people running it? And does it sell for a price that is attractive? From my personal standpoint, running Berkshire now, because we've got pro forma for Gen Re, I don't know what we have, maybe 75 or 80 billion dollars to invest, and I only want to invest in about 5 things. So I'm really limited to very big companies. But if I were investing $100,000, I wouldn't care whether something was large cap or small cap or anything. I would just look for businesses I understood. Now, I think that on balance, large cap companies as businesses have done extraordinarily well the last 10 years, and way better than people anticipated they would do. I mean, you really have American business earning close to 20% on equity, and that's something nobody dreamed of, and that's being produced by very large companies in aggregate. So you've had this huge revaluation upward because of lower interest rates, and then much higher returns on capital. And you know, if American business is really a bond, disguised bond that earns 20%, has a 20% coupon, it's much better if it's a bond with a 13% coupon. And that's happened with big companies in recent years. Whether it's permanent or not is another question. I'm skeptical of that, but I don't. I wouldn't even think about, except for questions of how much money we run. I wouldn't even think about the size of the business. A good small See's Candy was a $25 million business when we bought it. I mean, if I could find one just like it now, even as big as we are, you know, I'd love to buy it. And it's the certainty of it that counts. Yeah, way over there.
You mentioned earlier buying stock in every company is public. One thing, until the last 5 years, real estate has been primarily private. We're now seeing a great securitization of real estate. And what is your insight into the industry?
Yeah, you're talking about real estate equity. There's been securitization, enormous securitization of the debt, too, of real estate. And that is one of the items right now that is really clogging up the capital markets. I mean, the mortgage-backed securities they're just not moving in commercial mortgage-backed, not residential mortgage-backed, and so that's. But I think you're directing your question at equities probably, and the equities. If you leave out, the corporate form has been a lousy way to own equities. I mean, you've interjected a corporate income tax into something that people individually have been able to own with a single tax, and by having the normal corporate form, you get a double taxation in there you really don't need with real estate, and it takes away too much of the return. REITs have, in effect, created a conduit so that you don't get the double taxation, but they also generally have fairly high operating expenses. And if you get real estate, let's just say you can buy fairly simple types of real estate on an 8% yield or thereabouts, and you take away maybe close to 1 or 1 and maybe even 1.5% by the time you count stock options and everything. It's not a terribly attractive way to own it. Maybe the only way a guy with $1,000 or $5,000 can own it. But if you have $1 million or $10 million, you're better off owning the real estate properties yourself and sticking some intermediary in between that will get a sizable piece of the return for himself. So we have found very little in that field. You'll see an announcement in the next couple of weeks that may belie what I'm telling you here on one thing. So I don't want you to think I was double-crossing you up here. But generally speaking, we've seen very, very little in that field that gets us excited. People sometimes get very, very confused about. They'll look at some huge land company. I'll take one that won't evoke any emotional reactions on the part of anybody, like Texas Pacific Land Trust, which has been around over 100 years and got a couple million acres in Texas. And they'll take they'll sell 1% of their land every year, and they'll take that as applying to everything and come up with some huge value compared to the market value. But that's nonsense if you really own the property. I mean, you can't move
Here is a key point from Warren Buffett's speech. Warren Buffett emphasizes the importance of understanding the businesses you invest in, suggesting that deep knowledge of a few companies is more valuable than broad diversification. He argues that most investors should stick to index funds for broad market exposure, but those who truly understand the businesses they invest in should focus their investments on a few key companies. This approach, he believes, leads to higher returns and reduces the risk of mediocre investments. Buffett's investment philosophy centers on the concept of circle of competence. He stresses that investors should only invest in what they understand thoroughly. By focusing on businesses within their expertise, investors can make more informed decisions and avoid the pitfalls of unfamiliar industries. Buffett's own investment strategy reflects this, as he prefers to hold significant stakes in a small number of well-understood companies rather than spreading his investments too thin. Another crucial aspect of Buffett's advice is the value of patience and long-term thinking. He advises against frequent trading and market timing, advocating instead for a buy-and-hold strategy. This approach allows investments to grow over time, leveraging the power of compounding returns. Buffett's success with companies like Coca-Cola and Procter & Gamble exemplifies the benefits of holding quality businesses for the long haul. Buffett also highlights the importance of evaluating the management of the companies in which you invest. He believes that good management can significantly enhance a company's performance, while poor management can undermine even the best business models. Therefore, he places great emphasis on the integrity, competence, and alignment of interests of a company's leadership. In terms of portfolio construction, Buffett advises against over-diversification. He argues that owning too many stocks can dilute the impact of your best investment ideas and complicate portfolio management. Instead, he suggests that investors should concentrate their holdings in a few high-conviction investments, where they have the highest confidence in the business's future prospects. Buffett's investment principles also include a focus on intrinsic value. He believes that the true worth of a business is determined by its future cash flows, adjusted for risk and time. By comparing this intrinsic value to the market price, investors can identify opportunities to buy undervalued stocks and sell overvalued ones. This disciplined approach to valuation helps avoid the emotional traps of market fluctuations. In discussing specific businesses, Buffett praises companies with strong brands, pricing power, and durable competitive advantages. He cites Coca-Cola as an example of a company with exceptional pricing power and global reach, making it a compelling long-term investment. Similarly, he views Procter & Gamble as a diversified consumer goods company with robust brands and stable demand. Buffett's investment strategy is also characterized by a preference for simplicity. He avoids complex financial instruments and speculative ventures, favoring straightforward businesses with clear and understandable operations. This simplicity reduces the risk of unforeseen complications and makes it easier to monitor and evaluate investments. Finally, Buffett's approach to risk management is conservative. He seeks to minimize permanent capital loss by investing in businesses with strong balance sheets, reliable cash flows, and low debt levels. This conservative stance helps protect his portfolio during economic downturns and market volatility, ensuring long-term capital preservation and growth. In summary, Warren Buffett's investment philosophy revolves around understanding businesses, focusing on high-quality companies, exercising patience, valuing strong management, avoiding over-diversification, emphasizing intrinsic value, preferring simplicity, and managing risk conservatively. These principles have guided his successful investment career and continue to serve as valuable guidelines for investors seeking to achieve superior long-term returns.